Okay, happy Friday, everybody. Today, take a look at HOOY for the YieldMax HOOY Income Strategy ETF. Just a quick overview, how it's been doing, how it's structured, what it's owning right now, and some of those metrics. So jumping right into it at the YieldMax website, just a note, the fund doesn't invest in the HOOY directly, it invests in the synthetic position. So it basically buys a call, sells a put, that creates a option vehicle that basically tracks the underlying stock price as if they own this, as if they own the shares directly without the capital investment, of course. Then they use that as collateral to sell call options against or sell credit spreads against. Credit spread is like selling the call option. Just in addition to selling the call option, they also buy a call option further out in the strike price. For example, if you're going to sell a call, if a stock's at 100, you sell a call at 110. That is a common cover call approach. Selling the credit spread would be if your stock's at 100, you sell the 110 call, but then also buy the 115 call. In a similar fashion, you generate premium, not as much premium. However, if the stock runs to 120, you capture the upside from 115 to 120, so you don't lose out on all that upside. So it's like an insurance strategy using this method. But so far, this fund opened at $50 a share. And the distributions, as you can see, the first one, I guess, was $3.30, which not bad. And then since then, it's been $6.50 and almost $6.90. So these last two distributions have been over 10% of what the initial share price was at inception date. As far as how this stock has been doing, so if you go to Yahoo Finance, I guess first to cover, Robinhood's been on a tear. For people who follow the markets may realize, currently sitting at market close at almost 105 a share. You can see, I guess, for the year, it, shot up to the 60s prior to the Liberation Day, and that fell back down to the mid-30s. And then since then, it's been on a rocket ship past 100. So therefore, I guess you'd expect HOOY or YieldMax strategy has also been doing decently well, which it clearly has. If I go to the chart here, not sure the chart will load. It's only been, it's been around since May, so it loads all the information since May. Opened at 50. This shows just above 50, but did shoot up, I guess, to high 70s. Currently sitting at 67. I'm doing really good from an overall perspective. In order to track that, I do have a site here. Tracks all the YieldMax funds, but specifically looking at HOOY or HOOY. Let this tab load, sheet load basically, but okay, so it's loaded. It basically shows if you would have taken 55. So it assumes that you start with 100 shares. So if the initial price was $50 a share, it assumes you started at 5,000. I think this is how you'd be doing if you would have owned Robinhood. The underlying equity, if you would have bought the YieldMax fund to reinvest your dividends, or just bought the YieldMax fund and put your dividends into a checking account. You can see all three scenarios have been quite well. Due to the capped upside on the YieldMax funds, the actual Robinhood underlying equity has been doing the best, but that is expected for a stock that has been going straight up since this fund opened. Distributions per share, as you can see, I already pointed these out on the YieldMax site, but the average has been right here at over $5.50 a share so far, so pretty good. As far as your total return, currently the share price is sitting, I guess this had it when I was clocked at 72, but you can see let's see, on the week, it was at 72, but then of course, the reason it came down is because maybe you see that dip there. That dip's not like an actual dip. It's the fund paid out that almost $7 dividend. So the fund clearly had a step change down about that same amount. Yeah, this price captured it right before the dividend was paid. So it's probably better to assume it's at 67. That said, if you look at the total return, you're going $16.70 so far in total cumulative dividends. And then with the ETF price added to that, you're just below $90 a share in terms of total return for a vehicle you bought at $50 a share if you would have bought right at the inception date. And then these are just some of the variables, the yellow line being your dividends green line being like the cumulative dividend, basically these. So the third point would be the previous three dividends added together. Blue line is the ETF price or the HOOY price. And then purple is, of course, your total return. And then for those who want to dig a little bit deeper, HOOY. So if you go into the actual YieldMax site, they do have a holdings section where they say exactly what they own. For those that don't know how these funds are structured, basically they take a lot of money and put it into treasury bills or cash equivalents. They use that as collateral to open synthetics where they buy a call and sell a put. Why would you need collateral on buying a call and selling a put? Well, the buying the call portion, I suppose no collateral is needed, assuming you got the capital to buy it, which they do. But when you sell the call portion of it, there's collateral that needs to be set aside in case the stock were to fall drastically. So if the stock, if you bought or sold or on the section where they sold the put, I don't know if I said that clearly before, is where you need the collateral. So basically, if you sell a put at 100 for a stock that's at 110, but then the stock falls down to 50, clearly you still have to buy it at 100 since you sold a put or you sold that obligation to buy it to somebody else, or you sold somebody else the right to have that obligation put on you, I should say. So if the stock falls to 50, someone else has the right to have you buy their shares from them at $100 a share. So that's why they require you to set that collateral aside so that you can execute those puts that you sold accordingly. And then they have their synthetics that are structured where they buy the call and sell the put, but then they also have other calls that they sold in order to generate options premium. If you click to download all holdings, it does show you exactly what the ownership structures looks like. So here I have downloaded the holdings for HOOY as of 7/25/2025, and I did color code it accordingly ahead of time, so I wouldn't have to do that kind of on a live feed. But overall, basically what I'm showing here is in green is their cash and cash equivalents, and blue here is the aspects of their synthetic. So you can see they got an $80 call or $80 put and $9 put that are sold, and these same amounts. So you can see like 8,200 here, and then you go down 8,200 here. You got the call and the put that are, the call is bought, positive shares, the put is sold, negative shares. And by shares, they should probably say contracts, which one contract is equal to 100 shares. And then they also got the 90 call and put relationship there. And then everything here in this yellow or gold font is the contracts that they basically are using to generate options premium, which they use to pay the $6.89 or 90-cent dividend that they just paid. So overall, you can see everything that's negative is what they have sold, and then everything that, and you also can see the strike dates. For example, 7/25. And you also got the 8/25s here, or that's sorry, it says 8/25. Doesn't mean 8/20/25. It actually is. If you look over here at the cusp, it's 8/1/2025. It's just not structured in the same terminology as the 7/25 is. So you can see they got call options here that are sold for 8/1/2025, but then anything here in positive territory are those insurance contracts that they have bought, so they don't lose out on all upside if Robinhood, the underlying equity, goes on a tear. So that's what it looks like from an Excel spreadsheet. I want to pull up, I basically take this data here and I try to make it more visually enticing, so you can see relative magnitudes in like a bar chart like frame. So I'll pull that up here now. So back to the website here. So I created a website to hopefully make the data previously shown on an Excel spreadsheet a little bit more visually enticing. Basically what this does, it takes the data and puts it into a Tableau kind of dashboard, or I guess it's a worksheet, but it shows the bar charts of the relative sizes or shares that are sold and bought. The synthetics, rather than showing those, I just got a red line here. It shows you at 80 and at 90 they have synthetics. If you want to see the actual synthetic, what it's made up, I got the synthetic makeup tab. So you can see of the synthetic, you got 13,580 shares at the 90 strike and 8,200 shares at the 80 strike. I don't actually have the bar charts in there because those would be rather large. And what I want to focus on is the contracts that they have sold and bought. So at the 725 strike, which would expire today, you can see they did have the 105 strike, which I think that might have just expired worthless. If you look at Robinhood stock, did it hit 105, 104.85? So it looks like that expired worthless. And then basically everything above that orange would have expired worthless with the end of trading today. And then in red, it shows you the contracts they already have initiated for next Friday or August 1st. So you can see they got some sold at the 109, 110, 111, 114, 115, but then they start buying them at the 119, 120, and the 121. So that's how you're looking. I will refresh this clearly next week, but expect all the orange bars to go away, the red ones to stay, and maybe new positions to be added as they add them. As far as how the fund's made up, I got the makeup as far as the entire ETF or just on a per share basis. So you can see HOOY is trading at 65.81 roughly. Of that, it's got three components that make up that share price. Here's their cash and cash equivalents. Here's how much their synthetic position's worth. And then the contracts they have sold net acts as a negative 44-cent drag on the share price currently. And then, so here I just like to show with their synthetic positions, they have 21,780 contracts that they can use as collateral to sell positions against to generate more options premium. Of that, they've used all their collateral except for 3,880 contracts. So therefore, those are uncapped, sitting there. They can be used in the future to sell calls against, or they can just basically track the underlying equity of Robinhood. So if Robinhood goes up a lot, having aspects of your synthetic position that aren't capped could be a good thing. But here I show the total insurance. So of the shares that they have sold, they got 15,320 contracts that they basically bought at higher strike prices, giving them a 70% insurance percentage. Then here, overall, I guess the fund started in Mayish, and since then, probably need to update the tracking, but since then it's been on an upward tear, clearly with the underlying equity. Yeah, and then as I already noted, there's a few other more detailed items, just breaking the same charts I broke down on a percentage basis or a market cap basis. And then finally, I already showed this with the synthetic makeup of their call. But yeah, overall, I guess that's a breakdown of the HOOY ETF. We'll track it going forward and see how it does.